Welcome to the Real Estate Power Play Podcast, your launch pad for skyrocketing success in real estate investing. I'm your host, Gabe Rodarte, alongside Mark Monroe. We're ready to bring you transformative stories, groundbreaking strategies, and the insider secrets of real estate giants. Get ready to accelerate your investment journey and become a true power player in the world of real estate. Hey guys, welcome to the Real Estate Power Play Podcast. I am your host, Gabe Rodarte, and today I have a really special guest, a good buddy of mine. We've known each other for about a year now, just kind of connecting through social media like we do in this world. And so we're gonna just dive into this. I got so many questions for Logan and what he's doing, and a lot of people know him. If you are a follower of the Power Play podcast, you probably heard him because we do creative financing here. We do creative strategies from residential to commercial. And we talk about that while we're here, of different ways to pivot and move a property through the process. You're probably on seller financing homes or creative financing strategies and one of the other platforms that we have. So this is going to be right up your alley. You're going to really love this, because this man is all about creative strategies. I've taken some tips and hints from him as we do some of our land projects. So here we go. Logan, what's the word, bird? Man, how you been?
Hey, I'm doing great. Thanks for asking, Gabe.
Hey, thanks a lot for being on. And for those who might not know, run through quick synopsis. How'd you get started? What are you doing now? What's happening? What's exciting? What are you doing?
Well, quick bring today. We've got a market that's somewhat stabilizing and maybe slightly starting to improve. We might be at the forefront of a recovery, although some people say we're at the forefront of a recession. I don't know the answer, but
yeah.
I see just stability in our pipeline, which I like on both ends, the front end and the back end. And that's been really disconnected in the last 5 years. We've had lots of good front end on the pipeline, and then things won't sell as well, like in the last 6 to 18 months. Before then, we'd have crazy response on the sale end of the pipeline, but getting the deals were harder because there's so much competition. We have a really interesting balance right now, and I'm liking that. So our operation includes about 50% distressed property acquisition. There's no bad product, only bad pricing. We buy it with extreme problems. We'll pay 10 to 50 cents on the dollar, solve those title problems, ownership problems, disputes, whatever, and then just take it to market. Not remodeling, not doing any of that work. That's about half the business. I've got another quarter of the business or so is land development. So buy land, subdivide it, entitle it, get the utility agreements done, development agreements, and sell it to the public builders. And then we've got an industrial portfolio that does about 80 grand a month in net operating income. So when you kind of combine all of those business lines, that's what we do under this, rooftop with about 20 people.
Nice. So, so how'd you get started into that part though? But before that, you were doing, you're in oil gas, right?
Right. Yep.
And then you moved into some land acquisition, moving some stuff around, and then you started figuring out creative strategies, right?
You're right. I was full-time project manager in the pipeline companies, building pipelines across South Texas, oil and gas stuff. And before then, I inherited a bunch of money when some family members passed away. And I was a really bad steward of that money, hence the reason I went back to work. That money should have lasted, a long, long time. It didn't. It lasted 3 years. When I got out in this oil field, I'm looking at the money I'm earning working 12-hour days. And while it was great money, it was nothing compared to what I'd burned. And I realized I got to have a different strategy because I don't want to be broke again. And this money doesn't come as quickly as I thought it would. So I was saving for several years. I started buying infill land in San Antonio while I was traveling in the oil field. And back then, this was, 2014, 15 range. You could buy an infill lot for $5,000 or $10,000 here in town.
Yeah.
So I spent several $100,000 that I'd been earning and saving, picked up a couple dozen lots. And I ended up getting laid off from the oil field right about the same time I'd gotten some unsolicited calls from realtors. There were builders wanting to buy land, and not much was on the market at the time. It was early in the last market cycle, but I got some incredible offers, for a couple $100,000 for land I'd bought for 100 or 200 grand. And I realized, holy cow, like I'm onto something. I can recapitalize and I'm not out of cash anymore. I'm about to start a real estate business, I think.
Wow.
And the other part is I could sell the first couple lots and generally recapitalize for the entire investment play. So I get a couple hundred, $200,000-$300,000 in return after selling a few lots, but I still have 20 some lots left. So I realized like I'm onto something big here. And that's really what truly started the real estate investing career.
Wow. And then because I remember some of your story of just how you started getting into the creative side, but and to kind of like rapidly get to the stuff, because I want to get to some of the tools that some people probably really want to hear and need to hear in this current market. But you started moving stuff more into larger commercial, larger type properties that were just creative financing, and also you use a term delinquent title. What do you call it?
Delinquent tax.
Delinquent tax. But what was that? Distressed title? Is that what your phrase is? Or
Mostly distressed real estate, but curative
okay,
title, it's a skill
curative
that's
title.
yeah.
Got it. Got it. So when did that start happening where you're like, oh, crap, this is not just a normal real estate business. Now I'm working on commercial stuff. Now I'm doing stuff I never even thought I would be doing.
So right. So the first theme that really stayed with me forever is protecting downside risk and managing capital. When I went through all that money early on, I realized how quick it went. And I realized if I'm ever going to build any real wealth, like I've got to be better with money. So I did start out with a very strong discipline around finance my second go around when I got into real estate. And after I just did that play that I told you about, I bought all that land and started selling it. I realized, holy cow, this is a gold mine. Let me go back and buy some more of these $10,000 lots. The problem is the word was out and they were no longer $10,000. They were $100,000. But one of the properties that I'd bought during that time had title problems. And it was one of the few I didn't buy with title insurance. I just got sloppy and the guy said, I'll sell you my share. Long story short, I just paid him $5,000 and got a deed and recorded it. Well, when I went to go sell it, title company said, you're one of 9 owners. And these 9 other
Wow.
owners have judgments and liens and all this stuff.
Right.
So I had no idea what to do. They referred me to a local attorney and I went to his office and just started paying him hourly and doing this Q&A. Let's try this. How about that? And over the course of the summer, I was able to reduce the judgments and liens, strip some of them, aggregate all the rest of the shares. And that was still a very good margin deal, but I'd done it recently. And I thought, holy cow, if there are more properties with title problems like this, I can still go get $10,000 properties again that are currently worth 100 plus. And in that moment, I was like, this might
Wow.
be an option. So I intentionally started focusing on that. And I had no idea how many problem properties were out there. And I don't mean when wholesalers say we buy distressed property, meaning it needs a remodel. That ain't what I mean. I mean
Yeah.
stuff that wholesalers throw away that they can't close because it's got
Right.
missing owners, $200,000 IRS liens, just breaks in the title chain, like the worst of the worst.
Right. So, and that's really cool. I'm when I started getting into doing some of those things, I didn't know about these IRS liens that could be waived. I didn't know about some of these other things that were going out there. I just didn't know, and I fell into some of it. And some of my sweetest deals were these things, right? And what's really cool is that I'm talking to, there's some times that we would talk to the actually credit card companies that
Yeah.
don't want to release it for the wife who was blind, to this person who was offshore, to that person over here. And I'm like, you think we can lower the payment? So we're lowering the payment of the payoff on a three-way call with credit card companies, and didn't know we could do some of this stuff, like no clue. And I'm just having a heyday doing it because I'm like, I like the hunt of the deal, right? Like I love the fact of like, okay, no, we need to get it a little bit lower and the whole thing, and it's just kind of who I am, and I'm really enjoying this process. And at the end of the day, the guy's just like, man, you just not only did you just save my butt, I'm actually gonna walk away with a little bit of money. And I'm like, yeah. And I'm like, I'm gonna be able to walk away with a lot of money.
Yeah.
And because I was able to create this gap that wasn't there before. um I just think that was amazing. Like that was just like,
Yeah.
some of these deals that you just do these miracles on, you'll always remember them, right?
Absolutely. You hit the nail on the head there. It's a very efficient use of capital. It uses a little more time, but the capital goes a long way. The returns go a long way. And the neat part about this is I started doing this with small lots that were worth, I don't know, 5 figures, 6 figures maybe. But I was always very careful about what I got myself into next, because if I'd never owned an apartment and I didn't understand it, I didn't want to
Right.
get involved in some big one. So I'd do a fourplex and then a 12plex and then a 15. And, next thing you know, I was finding these same situations surrounding commercial assets, ranches, large high value property. And after doing it, at this point, it's been about 10 years. So as you work your way through that curve, reserving capital, I'm not faced with the normal constraints that a lot of people are, like, who am I going to get to lend on this? I have the money in the bank. So I
Right.
can make that decision. I can risk my own capital. And when someone tells me something crazy, like we got a deal in South Lake right now, I'm in Houston, the semi-rural lot is worth about $1 million, a couple acres. And we bought our position of 95% for 100,000. As you
Nice.
start to work your way through this curve, 100 grand sounds like a lot of money, but when you're faced with the opportunity to buy 95% of $1 million asset, so 950,000 in equity, 100
Right.
grand is nothing. And if you have it
Right.
in your bank account and you don't need it for bills, or it's there to use as this tool, that vanishes out of your account quick into theirs when you can pick up nearly $1 million in equity. So we started working our way up that curve on bigger assets, but still very mindful spends. We would buy a 50% share in a $500,000 deal for 5 or 10 grand. We could afford that. We're taking that risk. And when it would work, we'd say,
Right.
wow, let's work our way up the curve. So today, uh, I have several transactions that are 5 and $10 million. That's not common, but a very common number is several $1 million today for these kind of deals.
Yeah, that's awesome to hear. And that's probably really encouraging for most people and also very daunting, right? Like this, you're talking about, we have listeners go from, residential, single family, maybe they just got started, they don't know really where to go. And then someone who's, at a place of going, no, I'm actually doing commercial. I have a couple industrial buildings. I would like to acquire more. I just really don't know how to get in front of them. And,
But see,
it's
the,
always
the thing
about,
is, there's a lot of risk there. So if you're able to buy your risk down by saying, I'm going to get into this relatively big deal or bigger than normal for enough money that relatively doesn't change my life, 5 grand, 10 grand, 30 grand,
wow.
all of a sudden those barriers to entry go away, because usually those barriers to entry matter because the dollars are so much. But if you
Yeah.
reduce that part of it, at that point, all those hurdles and barriers matter so much less that you say, like my first couple big deals, I didn't know what I was doing. I had no clue, but I
Yeah.
knew I had the money and I knew I could put it over there and try to figure it out. And because you have so much equity in it, I had room to make all the mistakes and I made them all. But that
Yeah.
was okay. They didn't sink me because I had so much equity. That's how I learned. Just fuck it
Yeah.
up.
Yeah. So when you talk about that, just to kind of give someone an insight of like what you do, and I know that you have your own coaching and you have your own, process of how you help people go through that. When you talk about these barriers of entry and you can buy a position, help us understand, help those listening. What does that really even mean? How do you buy a position? This isn't stocks. This is
Right.
this is real estate. So how do you buy a position of a piece of real estate?
So a really easy example is, Gabe, let's say you and your brother inherit some property or y'all buy it together as partners, any combination. You just become co-tenants. That's a Texas thing. Tenants in common. Normally, people need title insurance when they make a purchase. They're using debt. So, in order for someone to buy the property from you and your brother, they're going to have to go get a loan. They need title insurance. You and your brother both need to come to the closing table and agree on the same price at the same time and transact. That's a very common real estate transaction today.
Right.
But let's say you're a knucklehead and you hate your brother because y'all grew up in separate households and you hated his dad and he hated your mom and all these crazy things. And
Right.
you say, you know what? I'm not going to sell to spite you. But the brother says, I want access to my equity. I want to get out of this deal. I can buy your position, your interest, your 50% undivided interest. I can buy that in Texas, just purchase it without title insurance. It's just a deed, a contract, and cash. That's it. So I
Got
can
it.
buy your share, but now that let's say you're the hard guy to deal with. So let's say your brother, I'll buy your brother's share.
Right.
Now I come to Gabe and say, hey, Gabe, we're business partners. I know you've been
Right.
screwing your brother around, but that ain't me. Let's cut a deal where I can buy your share. We can go to market together or whatever, but I'm also going to get paid for solving all these problems. Y'all got judgments and liens, delinquent taxes. You haven't paid any of that and you owe half. So I'm going to go fix all those and let's cut a deal to go to market together. And you might say, yes, answer solve, problem solved. We go do that. You might say, no, F off. And then I say, okay, well, I'm going to go fix these problems. I'm going to send you the bills. And in Texas, A co-tenant must not threaten the equity of the other person. They must maintain their share of the deal, more or less. Um, Otherwise, I have a claim against you. So, Gabe, I'm going
Wow.
to go fix all these problems, and I'm going to send you the invoices, and I hope you pay them. If you don't at the end, I'm going to sue you, and I'm going to get an equitable lien against your share of the real estate, and I have the right to foreclose on that. So, hopefully, we'll take the carrot instead of the stick, but I got either. So, call you back in a week, and I'll let you know. Well, then you can tell me which one you want. That's the
Wow.
pitch.
That's awesome.
Yeah, it's fair but firm. When one bad person is holding up a bunch of good things, I have zero sympathy for them. Now, there are things
Right.
that complicate that process sometimes. Lots of variables. Who lives in the house? Is it a ranch? All these different things. Have you paid a little bit of the taxes, but they paid the others? At the end of the day, that's a general concept.
Yeah. Yeah. So for those who think about that, like this is this is I love the creative strategies of all of these things, right? Because we do all types of creative finding strategies and stuff like that, but this is creative acquisition strategies, which is super fun.
Yeah,
Um, imagine someone who's like looking at this and going, "Oh my gosh, this looks like a huge bear. This is a mountain, Logan. Like, how did you figure that? Okay, forget how you figure. I have this property. You have a couple of attorneys on staff too, or you have attorneys that you that just to kind of let the general people know, like, hey, this is stuff that you kind of want to run through. This is not something you're going to do out of your own template that you figured out. Not you per se, but somebody else that figured out on Chat GPT or whatever. Like, this is something that you want to go through.
that's right. So I do have one attorney that's on staff, and then I've got 5 others that are just actively working for me on projects every month. My legal bills are anywhere from, I don't know, 30 to 50 grand a month, more or less. But that's like a considerable volume. I'm transacting several hundred units a year of stuff like this. So
Yeah.
most folks, unless they've got a background in real estate law, they're going to need some help with an attorney. But I always encourage folks to look at what's the risk? Is the juice worth the squeeze? If you're looking at a $200,000 house and you can buy a big portion of that for very small dollars, I know real estate attorneys seem expensive and everybody hates paying them because they think it's dead money. I love paying them because every time I do, I'm paying them $300, $400, $500 an hour to fix a little piece of a bigger equation that's making me tons of money. So, like, I don't know. I haven't run this report, but if I had to guess, my typical legal fees on a file is between $5,000 and $10,000. Some of them are significantly more, but I might spend 5 grand per file just to get
Yeah, that's
paperwork
good. That's
done
a
to get
good
an email.
ballpark for people to go, okay, for 5 grand. I mean, look, you're going to count this in for if you're going to buy it from a wholesaler, you're going to count that in. If you're going to buy it, if you're going to close
Right.
a title company, you're adding in title. If you can just add that in, going, this is
Just the
going to be
cost of doing
part of
business.
the transaction. Yeah,
Yeah.
totally.
So there is a lot of fear though, because folks say when they're looking at a rehab, they say, I spend this much on it to buy it. I spend this much to rehab. I'm selling it for this. All that data is right there. And in these projects, all that data isn't usually presented in front of you. You've got to learn, do some discovery, figure things out along the way. But in order to hedge against those risks, you buy down your initial entry price so much. So instead of paying 100 grand for 50% of a $200,000 property, I'm giving them 5 grand. That means I have $95,000 worth of mistakes, errors, extra
Right,
carrying costs, whatever the hell, and margin. And it's very rare that you're going to blow 100 G's fixing problems.
right. Do you do so to kind of skip through, so let's move towards some of the fun projects that we're doing right now, the stuff that you're doing as far as like I know you're doing some land development, you're doing some other cool stuff. What are some of the stuff that this is all that you're doing after the project is done? I'm guessing some of these projects are taking months to do, right? To run through the process, especially when you're talking about bigger parcels of land, multiple heirs, you name it. Um, while you're doing that, are you looking at that like a traditional underwriting or due diligence period where you're like, okay, we got this under contract. This is what we're going to do. We're going to pay this amount. I got 15% of this. This could be a land development. Do you start running your team and saying, hey, let's start digging into what's possible at that point? Or
No.
what's your position on that?
90%, 95% of this stuff is inventory to be sold. That's it. It creates cash.
Okay.
This is a misconception a lot of people get. I want some warehouses in my portfolio. I'm going to learn to go buy distressed warehouses. It's not quite that easy. You're narrowing your funnel, the top of the funnel, so narrow. If you do that, you're not going to get any deals. What we do is we buy by distress, not by asset class. So I don't really care what the product is. I have learned there's no bad product, only bad pricing. I'll take 7 acres with a shitty mobile home that's semi-rural to San Antonio. I could care less what the product is, but what matters to me is there probably a buyer for that product and how cheap can I buy it? And that 7 acres, if it's worth 100 grand and I can buy it for 20, I'll take it. It's just going on the market and it's just going to get sold and converted into cash, recovery of investment capital, and then conversion of profit. That's it. And once I get all this profit, that's what I'm using to buy warehousing and apartments. And
Got it.
the
Got it.
curative skills do come into play because you'd be surprised. Probably 1 in 3 or 1 in 4 of those acquisitions have problems. So we're able to use that to help trade down, but that's not the rule. When we're talking about a land development deal, I can't say I want 100 acres just south of Buda that's prime development and have title problems. Good luck. You'll never find
Yeah.
it.
Yeah.
But I've got all this cash that I made from flipping through shitty properties that I'll deploy on premium development land.
Got it. Got it. You know what I like about what you're saying is that we come into alignment a lot when it comes to how you're applying your capital and what you're putting it towards. Especially during this market, I get really, I'm more conservative than what I thought I was on my investments, and even to the point where some of my lenders are going, I would like you to take a little bit more risk with my, and I'm like, I'm just, as I go through, I just don't want to take the risks that seem foolish anymore. I don't want to do that. Or wild card type stuff. So what I like about what you're saying though is like, let's think about this as a strategy game of acquisition. And I remember, for those who don't know, you have a team of people that can do consulting calls and stuff like that. Just kind of like intro type things that I've been on with you. I've been, just my wife was able to get on with you and have an awesome conversation. That was really funny. But when you say that, I think people misunderstand. Like, we still buy residential properties. Like, that's still part of my thing. People ask me, I got another guy, a developer today, going, "Hey, I have something. Do you still buy?" And I'm like, "Well, yeah, of course I'll buy it." And I run across good construction teams all the time and sub teams and stuff. And I'm like, I don't want to get distracted too much in that space, but that's the revenue generating machine. Like, it just generates. And if the more I can be hands off, the more I can use my time wisely to go towards the stuff that you're talking about. And I think that sometimes we get caught up in this shiny object of, I need to make that buck. I need to get out of my job. I need to do these other things, and not understand that, especially in a market like this where we're kind of figuring out, where we are now. You
Yeah.
don't want to get rid of what you're doing. Like, this is something that you definitely want to work on as you're learning real estate and learning the business and learning these other things and learning these other strategies. You can still do this while you have a full-time job.
Yeah, a lot of folks, and I don't know if it exactly applies the same way I'm saying it, but a lot of folks say burn the ships, go all into stuff. In this case, I didn't do that in the beginning because this is it takes a while to figure this stuff out, I guess you could say,
Yeah.
to acquire the skills, and you got to be patient. And if you think you're going to rush them, well, you're not, you're wrong.
Yeah.
So you're better off taking your time and just picking a couple deals like this on the delinquent tax list and try them. Keep doing what works, keep your revenue coming. And I have a lot of guys that have been through our coaching program where they'll do our program for 4 or 5 months or whatever, and they'll continue running their operation. But at the end of our program, they'll say, "Dude, I made more in your 4 months than I did all year running my other business. Like, I'm done with that business." But I
Right.
tell them, "Hey, get this working. Make sure you feel comfortable. Make sure you get the resources. Make sure it's for you." Because while the money sounds incentivizing and encouraging, there are times where some folks say, "You know what? I like something that's more systematic and less custom, and I'd rather have a smaller margin and smoother running processes
Right.
than this choppy, unique thing." And that's just a personality thing. So I tell people,
Yeah.
don't burn the ships.
Yeah. Yeah,
Try it.
totally. And that's one of the things I see and real estate's so big, right? But some people don't understand, and it's not a negative. It's just we tend to look towards I think our minds just tend to look towards what's the activity for today.
Yeah.
What's the juicy thing happening right now? And Monday and Tuesday and Wednesday, we had some awesome badass stuff going on. And Thursday and Friday, I didn't feel like I did much. I just, did the monotonous, normal thing. And basically you're just pounding out emails and others. We were talking about that before the call. And that's part of the business. That's part of the thing, is just sitting in front of the computer and just sending out emails and say, hey, can we get did you get the engineer report? Did you get this other document sent? Hey, just wanted to follow up. Did you ever get a hold of that person? The county rep or whoever you need to get a hold of with that city, did they respond to us? All
Yeah.
these small little things you're relying on. I don't know, like I'm guessing some of the bigger projects, you're relying on maybe 10, 15 different people to respond to you,
Yeah.
right? To push this thing through. So it does look a little choppy because that's everyone else's timeline. That's not yours. You can't fix that.
You're right. Absolutely right. So that brings me to an interesting point. So you mentioned a few months earlier that these projects could take a couple months. Early on, probably 4 or 5 years ago, I remember running some reports as we were trying to establish this as a model. At that time, it was an idea and it was working, but it wasn't a model, so to speak, as it is today. And I remember doing some math and realizing our average inventory turn time was between 12 and 18 months, which is a
Wow.
lot. And this is all legal work, it's paperwork, it's negotiations, it's settlements, it's documents, affidavits, things like that. Sometimes getting into the local judicial system, but that was a lot. And while every one of those
Wow.
deals were whoppers, they'd make 100 to 200 grand a piece. I still realized, holy cow, man, if we have a problem for any reason in our pipeline, we have to address it so quickly because in 6 months, we're going to have a gap in a year that will just, be really bad. So what we started to do is, as we started to improve and get better, we started to look at the deals that were messy enough to get a good negotiation and get a good trade down from the sellers, but weren't so messy that it would take us 6 years to do them. And as we
Yeah.
progressed, we started to get better at identifying those. And we started to come up with this phrase in our office that it's just because you could doesn't mean you should. Or
Yeah.
is the juice
Yeah.
worth the squeeze? And
Right.
right now, we kind of have built out this would be the average avatar of a deal that we like in our office. And I would almost call it an average of everything in our pipeline. While we have some that are radically bigger, like we got a $5 million deal we bought 50% of for $10,000. We have another one that's worth $2 million. We bought half of it for $5,000. But
Wow.
outside of those several extreme outliers, our typical deal sells for about 250,000. We're in it for between $50,000 and $70,000, and it takes about 4 months from the time we contract the first share until the time we sell and get paid. It's about a 4 month ordeal. So
Wow.
that's our standard avatar. We really like to stay in that because we can turn that capital at least 3 times a year. They're big margins. If you invest 50 to 70 grand, you're gonna make 100 to 150. Those are
Yeah.
great returns.
Yeah.
And they're bite sized enough that if we make a mistake on one of them and it falls into the long lead time project that it's going to take a year or two, we can afford to let that capital sit and it
Right.
not hurt our business.
Yeah. That is really cool, man. And that's cool. When you first said, hey, I started seeing these things come in, my mind just kind of blew, like, man, it's when you find out, like, it reminds me of when you go through that, you ever go through that neighborhood that kind of fits every single avatar, right? That you had, like the distress of this, the grass of this, or whatever. And then you're going, there's the deal. Oh no, there's one there, there's one there. Like in the very beginning, I'm just like, there's one there, there's one there. I'm mailing this whole neighborhood. I'm gonna contact, like that's kind of what it reminded me of when you first said that. I was like, how did you sort that out? My mind would go just explode and going, there's opportunities everywhere. So that makes sense though. You went through that. So those who are listening to this, you can probably hear me get excited going, this is exactly what happens on the shiny object syndrome. This is exactly what happens while you're building any type of business. You have to figure out what avatar you're shooting after. What are you going for? I have a friend of mine, he does 30,000 square foot industrial up to 110. And he goes, I know exactly the person I'm going to buy from, and I don't know their name right now. And I'm like, really? And he just tells me, this is who it is. This is what they're doing. This is what they look like. This is their age. This is where they're going to move to after they sell this thing. They're going to move to Florida. They're probably going to be in this area. And I'm like, wow. And he's like, just everything I buy from happens to be these type of people. I connect with them. So why change it?
Right.
So,
You brought, oh, crud, get this phone down here. You brought up an interesting point a minute ago, and I thought it would make sense when we talked about looking at a neighborhood in the beginning and deciding what's going to happen and how you're going to cover all this. It made me think about the viability of a business model because when you start, your rosy colored glasses and you're getting every deal you can, and it's exciting, but all these things change. Your interest changes, your financial situation changes, the market changes, you learn more, your competency changes, all these things. And one of the most interesting things that I've found with this model, I forecasted this at the beginning because of the margins, but it's now been tested and I've been able to watch it as the market has cooled off in the last 18 months or so. We would sell for 95 cents on the dollar. I take it to market, discount it just a little bit, and let it sell quickly. And I cared about the velocity of that transaction because it recovered the investment capital quickly. But as the market cooled off, I'd always told myself, well, we won't be able to sell for 95 cents on the dollar. We're going to have to sell for 80 or 70 cents on the dollar, depending on how bad the market gets. But it's my belief that we still are going to have sale through. It's still going to continue to happen. And it was fun to be able to test that.
Wow.
And we had to really price downwards. But right now we're selling at about 80% of what we think. Like we look at the comparables, and comparables are taking much longer to sell these days than they did 2 years ago. So
Right.
we'll price about 80% below what the comparables say it should sell
Wow.
for, and that'll still sell. And most folks don't have that kind of margin to give up. But the neat thing is because we bought it for 10 to 50 cents on the dollar, we have the ability to give that discount, bring the velocity still to our pipeline, and be very successful in a market where folks are having to reshift and figure it out or go out of business or whatever.
Yep.
We were able to test that, and we've continued to grow this business for the last 10 years now, despite markets going like this. We've continued to add equity every year. We've continued to increase profits. Um, all those things have continued, not quite in a linear fashion, but every year has been better than the last. And most people can't say that.
Yeah, most people can't, man. And that's a awesome congratulations to you. Just kind of hear how that process works, man. Because I get excited when I see that. And I get excited whenever there's transparency in someone's business and you're just being very transparent, going, hey, these things don't work out all the time. Let's make sure we understand. This is not a perfect, this isn't the latest guy coming through town talking about flipping or wholesaling or investing strategy or whatever, and they're chasing the strategy from 2 or 3 years ago that they made their money on, and then they're trying to teach it to you. It's not that. It's literally, hey, this is a moving market, it's a moving target continually, and you have enough foresight to go, it's a moving market. 6 months from now, probably 6 months, where is this going to be? Okay, let's drop it a little bit more just in case. And the reason why I smile about it is because I think so much that way. Like, it's seriously, they're like, yeah, but the deal could be freaking awesome. Yeah,
Could
yeah,
be, or
it could
could
be.
not be.
But if it's not, are we hurt? Are you hurt? If it's not, well, I'm only going to walk away with 10. Well, then don't do it.
Dude,
Because
I've
if,
been poor before. I've had financial troubles before. And in the last 7 or 8 years, I got way more money than I ever can possibly spend or that I'm interested in spending. And the way I feel has changed. I don't wake up chasing the bills for this month or this quarter or this year. We got money that would last us the rest of our life if we were reasonable and didn't go bananas. And you wake up differently. You're
yeah,
comfortable, you're calm, your family doesn't have to worry about anything. They don't have to look at the account to go do stuff. When I go to work, I'm not worried about money coming in this week because our account balance, we're not managing
right,
cash balances daily.
right.
It's completely different. So you can look at big picture stuff. You can do it in a relaxed way. Your brain works better. It's a happier way to live.
Yeah,
So those things all contribute to that because we built the protection and safety and caution into this.
wow. Yeah, man, that's really good. And the cool part about it is that it doesn't sound like you're coming from this as, hey, I'm a tax accountant or I'm a CFO of this organization, or hey, let me show you guys how to, like, you're just coming about it by just a traditional, what most of us should be doing, as like, this is how you run an investment company. This is how you run a company that has a lot of moving parts. It's a business. So you don't control all of it, right? There's a lot of stuff that you're just going, I'm not going to be able to control it, but I got to prepare. So
What was really interesting about the perspective here, my brother-in-law went to Harvard Business School, works on Wall Street. He's one of the guys that run a $4 billion fund. I mean, it's really interesting. I get to have conversations with him often, and the principles and concepts we use are identical. And I realized if folks like us would have went to Harvard, we would have had a feeder into Wall Street, and we would have learned to do the same concepts, but with 3 or 4 extra zeros from the beginning.
right,
While he's incredibly bright and incredibly hardworking and all these things, I won't say that he's orders of magnitude greater than that
right,
of us, but they learned in a different way. So understanding that and trying to close the gap between that and where we're at has been a really interesting project, I guess you could say, because we look for deep value investments, and that's exactly what they do. And they look at all the same concepts. So, that's another challenge as we look at this business. How do we make it as big as possible and still maintain levels of protection and safety and
Right.
don't take on undue risk? So that's where part of the perspective comes from here.
Yeah, man, that's super exciting. And you have the track record and you've gone through the amount of transactions that you've done helps you for us in the commercial professionals and the broker group that we have. Um, just the whole side. We've done so many transactions. It's really not comparable anymore to like something comes up and we go, it's just how it goes. Maybe a newer agent that we have on our team, they get kind of excited over like, it's okay. Well, we've done over 3,500 transactions in the last 7 years. This is just kind of how the process goes and we'll figure it out. Don't worry about it.
Yeah.
I think that you've had you had more at bats. And what I like about what you're saying, which I don't know where you got this from, maybe it's just from life or maybe some mentor. But one of the things that I've had to do is learn from a good mentor of mine, basically say, most people try to swing for the fences all the time. And you'll do better in life over the long run if you get up at bat, which means you got to do the effort. You got to put the work in. You got to get the at bats in, but you just get those base hits and you're doing those bases and you'll have a better chance over the long haul if you do base hits and you're comfortable with the base hits and then you know what you're doing. And the home runs come, but they don't come by always swinging for home runs. And the gap between one home run to another is so big that you got to hit it. And if you don't hit it, then you're out of business. And I think that that's what, for some reason, I've just noticed, I guess through my life experience of being in the real estate investing world now for so long, I just kind of see it more common often of just like the home runs and the this and the shiny object and these other things and these fun toys. And I'm like, yeah, you can compare against Logan, but he's done this for so many years, for 10 years and these other things. And if you want that, you kind of have to start where he started. Like you can't just go and get this nice vehicle and this nice thing and these other vacations and this other stuff and there's all these expenses without getting the at-bats and the base hits. And so I know we got to go. I wanted to end on that because I think some people listen to what you're saying and going, dude, I'm doing it now. Oh my gosh, freaking, 10K for a 200K property. You kidding me? Let's go. And then I'm going, wait a minute. This is, he just got done explaining the whole model of how much energy and time and the team and the attorneys and everybody else. This is a tool to put in your belt over a long haul if you love this business.
That's right.
But it's not something that you want to just get rid of all the other tools and just use that one because you just don't know what kind of situation you're going to be in where you're going to need other tools.
That's right. That's absolutely right.
So that was my little rant, guys. Sorry about that.
Oh, you're right.
Man, Logan, it's been good. Thank you so much for joining us on the podcast, guys. If you want to get a hold of him, Logan, how do we get a hold of you? How does our people connect with you?
Man, I'm on Instagram. I spend most of my time Instagram and Facebook in the social channels. Just type in Logan Fullmer. Fullmer has 2 L's. Easy to get. We stay pretty accessible. It's me and a couple other people that are managing my inbox, but I don't know. It's me half the time. So yeah, that's how to get a hold of us. Easy.
Awesome. Yeah, he's pretty easy to get a hold of. Thank you so much, guys. Thank you for joining the show, and we'll catch you next time. Peace.